Hey, everybody out there. Welcome to An Attorney and an Accountant Walk Into a Bar. I'm John. I'm the attorney, and my buddy here.
I'm Kent, and I'm the accountant.
All right, Kent, what are we talking about today?
Well, today, John, we're going to talk about tax and legal strategies for high net worth family groups and businesses.
One of my favorite topics. Outstanding.
Let's get into it. Tonight.
Yeah, well, before we get into this fascinating subject of high net worth individuals and tax avoidance strategies, I am drinking a straight bourbon whiskey known as Walcott. I think it's extremely lovely. It reminds me almost of drinking brown sugar or almost like a cola. Extremely smooth. It's unbelievable the proof that this thing is, and it's like not even like drinking alcohol at all. One of my personal favorites and a great price point.
Wow. I haven't had much of that, but I hear good things, and you clearly love it. Tonight I'm actually going off the reservation. I got Herradura Legend, which is actually a tequila. But it's got an absolute smokiness to it. Artificial or not, it is very smooth, very tasty, a lot of sweet notes and caramel. It's just, and even looks like a whiskey.
Sounds great.
Yeah. You know, our client base and a lot of our interactions during the week, during the work week, we're fortunate enough to work with a lot of entrepreneurs. And those folks, when their businesses are successful, end up being high net worth individuals, and those individuals build high net worth family groups. And those types of folks have very interesting, they have very interesting ideas on how they want to preserve their wealth for generations to come. And because they have a certain level of wealth where they need to do tax planning that is above the, call it a state tax exemption threshold, right? For the individual now, we'll call it roughly around 11 to 12 million per person. So technically you'd have to have over 22 to 23 million in this case. It's been edging up just a little bit in each year.
So what's that mean? You know, you get 12 million. What does that mean? I mean, you get $12 million what? If you have a state that's 12 million, you get taxed, or what's the tax? How does that play?
Mm-hmm. You know the old adage, there's nothing more certain than death and taxes?
Oh, yeah.
Oh, boy. That last one, nobody thinks about, because on top of income tax, property tax, sales tax that people have during their lifetime, capital gains tax, which is a big thing that we help a lot of clients with deferring, there's the estate tax. So when your estate is above a certain threshold, like back in the day, it was only $1 million. Can you imagine that today in California, having $1 million threshold, that anything above it would be taxed at what's essentially 40%?
Anybody that owns a house.
That's right. And we are in a place where it will sunset, and by 2026 or so, if nothing is done, that cap is looking to go down, and that really will affect folks that are in such high real estate value areas, because it does include the fair market value of the current piece of real estate. So don't think it's just sitting cash. You're like, oh, I don't have 12 million in cash. I'm okay.
So what are we talking about? If you die and you get more than $12.5 million, what's the boogeyman? What happens?
The boogeyman is everything that is over that threshold. So you subtract that dollar amount. Everything over that threshold is subject to estate tax.
That's pretty high tax.
And that's
right?
pretty high tax.
Yeah, it's pretty awful.
Yeah. So our goal in helping clients is to do appropriate tax planning, and on your side, legal structuring, in order to avoid as much of that tax as possible, because they've built that wealth over lifetimes. And it's not a one-time shot. Don't think that, oh, well, I got it from grandpa, and so now that when I pass away, grandpa, we already paid the tax on grandpa's wealth. No.
No, again.
It continues to accumulate.
I think the really, really big boogeyman here that most people don't see is like, well, yeah, if I got over $12.5 million, maybe I got $20 million, my kids are going to have to pay a big tax. So what? They're getting more than they need, right? Why do I need to do this? Why do I need to do that? Well, it's more than that, right? Because this is the one I see in the legal side. You guys do the tax return. Somebody dies. They owe $5 million in taxes. It's all real estate. How are they going to pay that? Well,
right.
What are they going to do? They're going to have to sell something. And they're going to have to sell it now. Now, maybe they'll be really lucky and that'll be on the upside of the market. Maybe they won't be so lucky and times will be tough and they end up having to sell that asset at a fire sale or for something much less than what it's worth. So the estate can be diminished far more than just the taxes. And, some cases they can end up with very little. So you might be thinking, well, so what? The kids have to pay some taxes. It can actually have much deeper implications than that.
From my perspective, it could, well, how I would phrase it would be sabotaging a generational asset. So, for example, if they've built a business or have an investment that is cash flowing significantly, but it's illiquid, like real estate,
Right.
That the forcibility of sale in order to pay taxes because the illiquidity of the estate will cause huge ripple effects for the next generation. Because yes, there'll be a cash event, but it's typical that they're not able to repurchase that asset of the same quality. And a theory can be said that it churns assets. Right? It's a way of call it redistributing wealth, but the concept to the person that's built that wealth is very frustrating when they spent a lifetime accumulating assets for the benefit of their heirs, and they work really hard and really diligent, and they may be forced to liquidate as a result of tax code.
And consider the worst case scenario, which I don't think a lot of people consider. It's like, do you always own these assets by yourself? Well, not most of the time. Mm-hmm. Most of the time you have other partners, right? So you might have a business partner, you might have other shareholders. Mm-hmm. In the case of a piece of property, you might have another TIC interest, or it might be an LLC where, there's another investor in there with you, right? Well, trust me. If that other investor sees that, little Johnny now has the asset and he's got to pay some estate taxes and he's bent over by Uncle Sam to do that, he's going to buy that really cheap.
So you're talking about liquidating fractional interests.
Yes.
So when you have fractional interests like that, that is so ripe for the person that needs to liquidate to be in a detrimental position. At the same time, when we get into actual tax planning, valuing fractional interests is an area that is ripe for prudent tax planning. So like I can go straight into one of those strategies, which is simply taking a look at business interests and using the legal powers to create and form LLCs or partnerships or correct structures to hold those interests rather than just being in what you had mentioned before, just a TIC interest, right. To organize it in a way where then you can value at a discount, right, using proper appraisals, of course, to value that fractional interest to essentially shrink the estate. Think about putting your files in a zip file, and take all these big files and you shrink it down a little bit. It's almost like that. You create a compactness as a part of the appraisal so that you can fit more under, in this case, the $12 million threshold, right?
Right. So, but that's a really good numbers way to look at it. So I think the important question is now, all right, now I know that I'm going to be above that $12.5 million. Now I'm thinking about I don't want my kids to have to pay all that tax. I sure as hell don't want them to have to sell the asset to my asshole business partner or his wife or their kids or whatever it is, right? What do I do about it? What do you do about it? What would you do about it?
The answer on a tax side is to create a liquidity event. Backup.
Okay. What does that mean?
Otherwise sometimes known as an ILET. A lot of key factors that focus.
All right, Kent, what's that stand for, man?
It's a life insurance trust.
Irrevocable life insurance trust, right?
Yes. So the idea behind that creates, whether people know or not, the proceeds of life insurance are a non-taxable event, but it is to the beneficiary of that. But it's could be includable in a estate if it's set up wrong. It goes like the beneficiary is the person that passed away. You don't want to do that.
Okay. So you're going to buy a life insurance policy, right?
To create a liquidity event that has a pool of cash outside of the estate.
You say this like CPA stuff, liquidity event. So you're going to buy a life insurance policy, and when you die, the life insurance policy is going to pay somebody, right?
Yeah.
And you'd want it to be outside your estate so it doesn't get taxed, right?
That's right.
How do you do that?
You got to set up an irrevocable trust.
That's where I come in.
That's right.
That's right, because I'll make you an ILET, which is an irrevocable life insurance trust. So we'll create an entity that's going to buy the life insurance.
Yeah.
That's going to be outside your estate, and that life insurance can be used to pay the estate tax, or just for whatever.
Yeah. Well, the whatever is the administrative fees of their very diligent accountant and attorney to ensure that the estate is handled correctly.
Well, I like the whatever.
It sometimes includes a boat.
Right, or an airplane.
Yeah, that's true. That's true. I've seen that happen.
So that's one way.
Yeah.
Irrevocable life insurance trust, ILIT. What about if you just give it away? So you like get your estate smaller so that it gets under that $12.5 million. What can you do? Just like give it away? What would you do? Who'd you give it to?
So you can gift it. Well, you can gift it to anyone. One of the ways is creating it to charity if you're philanthropic.
But
charitable remainder
I
trust.
want my estate to go to my children. Come on now. Can I gift it to them?
You sure can. You sure can.
Well, that doesn't seem like a very good idea, right? Because if I gift it to my kids, they're just going to blow it. And I sure as hell don't want them to have it while I'm alive because they're going to screw it all up. So is there like some way I could give it to them but not really give it to them?
So if you put some structure on it, what would you recommend?
Just a plain old irrevocable trust. So we can create what's called a flexible irrevocable trust that you create and you appoint a trustee, and the trustee administers it during your lifetime per your instructions, and you gift into that trust for the benefit of your children.
But doesn't an irrevocable trust mean that I can't control anything?
Yes, it did in the old days. But if you have a good lawyer, a clever lawyer, he makes it what's called a flexible irrevocable trust. And what does that mean? A flexible irrevocable trust has a number of different qualities about it. There's really three main ones. The first one is that in addition to a trustee, which is an independent trustee that you're going to appoint, I don't know, it could be your father, it could be a brother, it might be your CPA, it can't be your lawyer. You're going to appoint someone to like own the asset, right? But you know he's sort of going to do what you say because he's your buddy, right? That's job one. It's like, well, it's irrevocable, no, you can't change it. Well, there's two other aspects we do to it. One is that we have a trust protector provision. So you appoint either another person who can change the trust if you need to. So, wow, it's not so irrevocable anymore, right? You can change it. You can, if you have another kid, you can put the other kid in there. If you may have one of the kids that maybe is being an a-hole and you want to cut him out, you can do that. If you want to change the big place we usually use this is when there's changes in tax law, or there's changes in estate planning laws that we can amend the trust to put provisions in there that will help with whatever the changes in the law are. So that's another place that a trust protector has a function. And the other thing that we do to make it flexible is it has decanting provisions.
Does that include wine?
It sounds like wine, doesn't it? So what do you do when you decant wine? You take it from a bottle and you pour it into another container.
Yeah,
right?
that's right.
And that's essentially what you do. You create another container, you create another trust, which is a container, and you pour the assets of the irrevocable trust into the new trust. And of course, the new trust has the new provisions in it that you want. So are you going to be able to like yank all the assets back and, do whatever you want? No, there's limitations on it, and irrevocable trusts are really important things for people to think about and contemplate and how it's going to work because they are huge decisions. But you essentially are gifting things to your children in trust that you retain some control over, even though technically we're not really controlling it because the IRS doesn't want you to do that, but you do have some strings attached to it, right, that you can pull it back or change it or make modifications to it, and that's the flexibility portions of it. So that's like the really important thing to understand about it.
How about for folks, that seems complicated, but, not everyone is in that multi-million-dollar phases. I know we were talking about high net worth family groups, but is there anything that's attainable for folks that it might be just shy of that threshold? Do you recommend trusts for people that are...
Okay, well, there's a lot of reasons to talk about trusts, and I think that's a little bit beyond the scope of this particular podcast, but, a trust in general, just your general, what you guys, accountants like to call grantor trusts, we just call them standard revocable trusts, which everybody has, right? I mean, not everybody, but most people have. If you go to the grocery store and you see grandpa in front of you and he's writing out a check and it says, Sam Smith, trustee of the Sam Smith Trust, that's probably just a grantor trust.
Sure.
And the reason for that trust is to avoid probate, which is a whole other conversation.
True.
It's to admit it has to do with estate planning, it has to do with, administering your assets if you become incapacitated when you die and all that. It's a different conversation, but that's kind of the fundamental. The irrevocable trust is one level beyond that, and that's a structure that you create to gift assets to. And I think the big bugaboo that people have about doing that, right, is, well, I've got $30 million, and I've got a lifetime exemption of 12 and a half.
Sure.
So I'm going to gift $12.5 million to it. And we're going to do all kinds of cool things for you, like we're going to adjust the basis, and we're going to get an appraisal, and we're going to make those assets look like less than what they're really worth, and we're going to write up a letter of appraisal to the IRS to get that, really cool. Well, let's look at what else that does for you. Well, it takes it out of your estate, right?
Sure.
So now you don't pay your heirs aren't going to pay income tax on it, right, or estate tax. What else can you do with that? Well, gosh, I wanted to use that money. I don't want to give it to my kids now.
Mm-hmm.
How can I use that money? Well, you can borrow it.
Sure can.
And guess what? When you borrow that money from the trust,
It's an encumbrance on the estate.
it's not income,
Yeah.
and it makes your estate even smaller. This is how rich people don't pay taxes.
When wealthy are thinking about this, there's always a component, and we deal with this with a certain pool of clients, that no matter how much they gift, and they gift the max, there's still an amount that's above the taxable threshold for their estate. What plans or advice do you give from a legal structuring standpoint to help mitigate that? Because they may have some years left. It's not like they're at the end of the rope.
Well, the big one is what I just talked about. You borrow money against some money you gifted. You borrow money against it. When you borrow money, it's a liability. It reduces your estate. You don't pay income taxes on it. You hear this. You see podcasts on this all the time. This is out there on YouTube a lot. It's like, why don't the rich pay taxes? How is it Elon Musk doesn't pay income taxes? Well, because he has all these assets, and instead of liquidating them to go buy something, he borrows against it.
Well, there's a nuance on there, because it's the type and categorization of taxes. We just mentioned that there was income tax, sales tax, capital gains tax, estate tax, capital gains, right? Long-term capital gains rates very, very, very heavily from what the income tax rate is. And so not only is it about putting assets in an irrevocable trust, it's about what assets on a taxable estate should you actually put in, because the assets, they'll call it, don't fit. Potentially, they are assets, maybe qualified small business stock under Section 1202, where you can take advantage of the differing rates for long-term capital gains. So, as you know, or if you don't know, when someone passes, someone gets a step up in basis for someone that passes. So what happens is, from a capital gains perspective, if the biggest analogy was with stock. Let's say Grandpa left you Coca-Cola stock, he bought it $5, and it might be trading at 100. At the date of inheritance, you receive it at a basis of 100 because it gets a step up in basis. And then if you sell it death day in one day, there's no capital gains as a result of that inheritance. Now, does that mitigate the estate component of it? No, but it takes a nice bite out of what could have been a large capital gains.
Well, I'll have to take your word for that, Kent, because you just melted my brain, which is why you need to hire a really competent tax professional if you're in this kind of bracket, so they can figure all this crazy stuff out.
Yeah. Well, let's talk about.
Because even I don't follow you sometimes.
Well, let's talk about charitable giving. Let's say you like a church or a cause that is a public charity or a foundation. There are distinctions there, because 501c3s, which are the categorization for public charities, and then you have Section 170 that talks about donating, your assets to qualified charities and organizations. You see a lot of very wealthy individuals create foundations, right? Gates foundations.
Foundations are wonderful, wonderful tools for doing that, if you're inclined.
That's true.
To be charitable. It's not a joke, right? So
correct.
You do have some kind of cause that you want to promote if you do these things. So if you're just about building wealth, and you want more and more and more and more, and you want to pass $1 billion empire on to your children, it's not probably the best way to do it, right? But if you are inclined to be charitable, this is a tremendous tool for reducing estate taxes and getting things out of your estate, but still retaining control over them. because the foundation is your foundation, right? And you still have control over how those assets are spent.
Yeah, it's funny. You mentioned in the beginning. It starts with tax, but as an accountant, I always actually advise clients you must be solid in the legal structure, irrevocable trusts, and the things that you want to set up, and that drives the planning. From there, we look at how to optimize it for tax planning. We don't start with this beautiful tax plan without proper structures in place. And so I think the attorney and the accountant got to come together to kind of have those two have a perfect balance.
Really, really important, I think, if you are considering this kind of planning, is you want to have an attorney and a CPA, whether it be a firm, if you're big enough that you have a big A firm working for you, something like that. They're working closely together, have good synergies, are talking to each other, and you don't end up being a ping pong ball between the two of them.
Yeah. Let's talk about where someone dies, what state. That can have a huge impact on the estate tax,
Exactly.
especially
And
at the federal and state level. Well, we live in one of the probably the worst states to pass away in.
Everything's bad in California when it comes to taxes, right?
But for high net worth families,
Or New York.
well,
I'm sure.
high net worth families, you can look at different states. Call it anywhere in between California and behind New York. There's a few pockets in there that are not tremendous for this, but there's credits, exemptions, there's state tax incentives. For example, California doesn't do a matching for 529 plans or a deduction for contributions for 529 plans when other states do, right? There's smaller things that aren't in the realm of the millions and billions that people can do over their lifetime that can help them save for the next generation that is dependent solely on where they live, the state and the jurisdiction that they live in.
So when you say where you die, right, it's like if I live in California and I want to take advantage of, say, Nevada, and I feel like, I'm on my last couple weeks and I'm dying of cancer, can I run over to Nevada and die in Nevada? Or are you talking about like actually being in
I'm talking about domicile and residency. It does take a bit of planning,
Right.
Quite a bit of planning. And we always tell
And you
clients
have to want to live there too, just somehow or another.
it's a lot of beautiful country between the coasts.
Yes, there is.
I tell you that. And we always make this joke or this saying that the difference between tax evasion and tax planning is when you talk to your accountant.
Timing.
Yeah, that's right. So it's all about timing. So if there's forethought and then planning involved, right, and you create a true reason for finding a passion for what else is out there in the great Midwest, then you can avail yourself of some really awesome tax planning.
Awesome.
Yeah, and it's also about timing of deductions too. So one of the things that we talk to clients about is about revenue recognition and the timing of taking certain income and taking certain expenses. So let's say you talk about dividends and when things are going to occur for your business. So like you're going to create a business sale. Like a lot of things for high net worth transactions, they create a liquidity event. Is the sale of a long-term family business. It is not always prudent to take that one big check right off the bat. Right?
This brings up a really, really important point. I cannot tell you, and I'm sure, I can tell you, but I can't tell our audience how important it is to start engaging a lawyer and an accountant long before you think about selling your business. Mm-hmm. How many times, Ken, have we had people come to us and say, well, the sale of my business is imminent. It's happening next month. It's happening in 6 months. I'm going to get $10 million. How do I not pay capital gains? And it's like, well, buddy, it's too frickin' late. And if you'd had this conversation with us a year ago, we could have avoided most of that.
Yeah, it's really about that strategic planning and timing, of course. So to avail yourself of QSBS, even if they weren't in that position at the outset, that can be converted with time, with planning, with forethought, with that conversation with the accountant and your attorney, because maybe even at the time of sale, it becomes an installment sale.
Right. There's so many things that you can do,
spread.
And then, but if you do it, if you come to us after the deal's done,
yeah,
then Yeah, and it's kind of funny. They're always talking. Well, I could do this and I could do that. And what about a trust in Nevada and I can hide the money? It's like, yeah, bud, you go do that, and you get caught, and you're going to jail.
Is the saying a penny wise and a dollar foolish? Because
I think it's a pound.
a pound
It's a British
foolish.
saying.
Yeah, it's a British saying, but we're here in the good old U.S. of A. So a penny wise and a dollar foolish.
There you go. Okay.
In this sense, back to another topic we had in another podcast was finding the right professional.
Right.
And if you find the right person, and you have that conversation, the hourly rate for that 1 to 2 hour conversation for somebody that needs this type of planning and engages with this type of information can save them quite literally a lifetime of wealth and can preserve wealth for multiple generations as a result of taking this advice and then taking action upon it before it becomes critical. So I can't tell you how many times that I've had a client that says, well, my mom's on the deathbed. What are we going to do about the trusts?
Little late.
Little late, nothing.
Yeah.
There's nothing to do. There was even a client that almost went delinquent on their payments to their life insurance trust.
Oh my God.
Because they forgot to make some certain payments.
And the life insurance company's gonna love to not have to pay, aren't they?
Oh, they love it. They're waiting for one missed payment. And so luckily they engaged with an accounting like us that we picked it up, and we usually see a reoccurring payment that went out there, and we didn't, and some were starting to be missed. And because the payment documentation got changed, but while the client was in hospice, we got, and still alive, we got the payments up to speed, and we got confirmation they got up to speed. And within 48 hours, the client's mother passed. And so we had an instated insurance. We'll call that as close as I'd like to cut it in the nick of time. And that provided a significant liquidity event for a state that was typically illiquid and held in real estate.
So when he says liquidity event, he means you get money.
Yeah. I like to keep it erudite.
Well, that brings up a point that maybe, we can kind of finish on here too. It's like, and this is not a sales pitch, but one of the things people really seem to miss is, and I don't know how many times I've done this. Well, someone comes to us, they're having some sort of tax event in their life. It's a capital gain, it's something like this or that or the other thing. And it's like, well, we're going to sell this property and we're going to get hit for $100,000 in capital gains tax. We're like, great, that sucks. We can do this for you. We can create this entity, we can create this structure, we can do a 1031 exchange, we can put you in a QZ, qualified economic opportunity zone. There's all sorts of things we can do and really mitigate that tax. And you're going to get hit with $100,000 in taxes, and maybe we're going to have to charge you $5,000 to do that. Mm-hmm. And they're like, well, that's too much money. I'm like, what? You're going to spend $5,000 to save $100,000, and you're like balking at the price? Excuse me? I'm not suggesting that you have to pay my fees. But what I'm suggesting to people is, look at what your professional is going to save you and be willing to spend most of that.
I think when you have a direct comparison in terms of cost to savings, that's usually not a big hurdle. Where we find the hesitation is where the planning has the potentiality of savings. And if people could live in a world of absolute certainty, we'd all make solid decisions in a heartbeat. So with
that's true.
Is trust
but
your professional.
we've also seen them do it when we know we're going to save money.
That's absolutely true.
And we're just like scratching our heads going, why wouldn't you do that?
No, that's absolutely true.
And you don't have to spend the money with me. You can spend it with anybody. But for God's sakes, spend $5,000 to save $100.
Yeah. Man, I think we could talk for hours on this, but I think I'm at the bottom of my glass.
Yeah, well,
so let's
finish
finish
find
this
the
up.
bottom of mine. There it is.
Cheers.
It's gone.
We'll save the derivation of this for next time. I think estates and trust in general. I want to talk about planning for, we'll call it the common man. You know, I think it'd be important for folks that if you don't have millions, there's still things you should do. You
And
know?
I think it's important for people to understand that you and me are also in that category.
You're darn right. That's true. Absolutely.
We don't have all these millions of dollars that our clients do.
But we're fortunate enough to be like a fly on the wall, to have a great understanding of it. So anyway, thanks for sharing this time with me, John. You know, carrying an accountant walk to a bar is always fun.
And I strongly recommend this Walcott whiskey. It's amazing.
So the all listeners out there, thanks for joining us. If you like what you heard, please like and subscribe, leave comments, send an email out to podcast@taxis.com. We really appreciate you guys listening. Join us next time for an attorney and an accountant walk into a bar.
Right on.
All right. See you guys later. See you.